Hello, all. This is Dr. Dave Maslak from reciprocity.com. The E is spelled with a 3. And in this particular video, I really want to talk about investing in high risk ventures or investing in the startups and things like that, Bitcoin, for example, versus just investing in traditional blue chip stocks, this sort of boring everyday stocks, and which one is actually a really good strategy for most people. So this is part of I'm a professor of innovation strategy and entrepreneurship, and this is part of my small business and startup strategy Saturday. In terms, I just provide help to people that are interested in small business and startups and help them in any way that I possibly can. So, what is my answer whether you should actually invest in sort of a startup versus investing in traditional sort of blue chip, regular stocks like McDonald's or GM and things like that? So my answer is, in terms of investing in startups, is that most people should not actually invest in startups. And if they do invest in any particular startup, it should be a very small amount of their entire worth. And I know that this is kind of counterintuitive in terms of what most people hear in terms of the entrepreneurial culture. And, I'm a professor of entrepreneurship, and, often there might be a push towards going and doing the entrepreneurial thing, but I'm here to suggest, and I'm going to tell you why it's probably not the best thing to do to go full force into creating some sort of entrepreneurial venture. First of all, it is extremely risky, and that is the big thing. So this is based on the premise that most entrepreneurial things actually don't do that well. Even if they don't fail, they likely don't perform like the way that they should. And there's lots of different reasons for that. And I'm not going to get into that in this particular video. But in terms of stock market or just regular mutual funds, that's what I think of or an index fund, right? So an index fund is you just take all of the companies on an index on a stock market. So the largest NASDAQ, for example, New York Stock Exchange, and you just take a portion of all of those stocks that are on the stock market. That's called an index fund. And you just buy that, or you buy sort of a traditional growth stock or value mutual fund, something that is just getting the large companies that are out there, blue chip companies that are out there, all the large ones, and investing and buying some of those stocks. You pool those together and you invest in those particular stocks. That is probably the preferred way. That is a preferred way for most people going into any kind of investing or thinking about investing. So why am I suggesting this? Well, there's a lot of different factors there. I'm just going to give you 5 of them. The first one that I think most people don't realize. So for example, I was thinking about Bitcoin the other day. There's lots of people there's lots of hype right now. It's 2018, early 2018, and there's lots of hype about Bitcoin. Oh, you should be investing in Bitcoin, and there's lots of things going on with Bitcoin. It's going crazy, and that's a terrible idea, right? And the reason why it's a terrible idea and why just investing in index funds is actually the best way to go, or large companies, it's because the large companies, smart banks that are out there, they're looking at Bitcoin and they're going to make the investments into things that are legit, sort of Bitcoin exchanges or Bitcoin technologies that are legit, and bring them into that company. And you're going to be buying that in the long run. So the smart managers are actually going to be picking up on these things and actually acquiring them, right? So that's a part of a well-managed company, large company, is that they are looking for technologies that are taking off and they're acquiring them and they're investing in them. So those technologies are going to be invested, or they're going to come into, if you buy into the stock market, you're going to be buying into those technologies anyways. And there's going to be managers that know what they're doing when they're making these investments, when you actually purchase that. And they're vetting that on a regular basis. I guarantee that's what's happening right now in a lot of large banks, or a lot of, some of the investment banks, for example. They're going to be looking at what kind of technologies in Bitcoin that they should be investing, or the sort of cryptocurrency that they should be investing in. They're going to be investing in the ones that are legitimate. and avoiding the ones that are not legitimate. The second thing that you want to think about is a common strategy of really successful investors in the long run is that they mitigate a lot of risk. So they're always very concerned about mitigating as much risk as possible. And when you're investing in one particular company, right? So a startup, for example, you're exposed to a lot of risk that's going to disappear. There's all sorts of different factors that you would never expect along the way that could actually sort of take out that particular company, right? So somebody might die. So maybe it's a team of 3 people. Somebody might die, for example. They might get divorced. They might decide that they don't want to do this anymore. The company the idea might not be accepted in the market for whatever reason. There's lots of different factors, and if you're putting a substantial amount of money in there, and substantial, I'm saying 10%, 15, 20% of your total net worth into a particular startup or a startup idea, that's a terrible idea because that could just disappear, right? And because of all these different factors that you can't control for. So maybe you're using a contract manufacturer, for example, and the contract manufacturer just disappears and takes your password on you on the things that you're working on, and there's nothing you could do, right? Or they sort of lock you out of different things. There's lots of different things that happen along the way that you can't forecast and you can't sort of see. So you want to mitigate those risks and just do things that are very, very traditional, very simple. And that's how you actually build wealth in the long run, because you're not going to be exposed to those sort of risky things. The third thing you want to think about with why you should just invest in mutual funds or index funds is simply you just want to mitigate the hassle, right? Investing in any sort of startup idea requires a tremendous amount of work. And that's actually what you're getting paid for at the beginning, is doing all of this work and probably not getting paid for all that work, right? So if you look at Reciprocity, it's been a tremendous amount of work. You look at all the videos I put out. You look at me actually creating this platform and hiring people and doing contract manufacturers. And there's just so much work that goes into it. Yes, it's, that there's all sorts of different factors and, writing. And it's just been like a giant headache. That to be honest, I wasn't expecting it was going to be that hard, but at the same time that there is all this hassle that happens, and I am investing in sort of traditional index funds for the most part. This is kind of a little side thing that I'm trying to see if we can get it going. And there's just so much stuff along the way that you forget about and that you just don't think about, and you want to mitigate all that hassle, right? You just want a hassle-free life. It's much more easier to have a hassle-free life where you're instead not focusing on one particular thing. So I kind of enjoy this, right? But if you didn't, and this was a lot of work, just pure sheer work, then you probably should be spending your time doing something else, like having fun and spending time with your kids, for example, or, going out and spending time with friends and family. I don't know what it is. The other thing is that the number 4 thing is that, investing in index funds or investing in mutual funds, it's really not all that sexy. It's kind of really boring. And actually, that's a good thing. Being boring with investments and being boring with life in general, that's actually a really good thing. That's how you actually build wealth in the long run. If you look at sort of successful people in terms of, once they have become successful, they're just not exposed to a lot of things that can be a giant crazy thing that will happen, right? So boring investing and being a boring investor, that's how you grow long-term wealth in the long run. All these sort of shortcuts and things like that, that's not going to get you to the wealth that you would like. The best thing is just focusing on trying to minimize all the sort of things that happen around you and just being boring. You can't talk about that, the story about, oh, wow, like I bought some Bitcoin and, I made thousands of dollars out of it. But you know what? For all of the people that actually bought Bitcoin and made thousands of dollars at it, there was as many, if not much, much more, that lost thousands of dollars at that. And they're not going to tell you that story. They're going to be all, I'm not going to say anything, right? So you have to be very cognizant of that particular effect. The fifth thing that you forget about is that if you're investing in anything, and it's kind of related to all these sort of hassles and stuff like that, if you're investing in any sort of particular startup, is that there's going to be a lot of conflict, right? So if you give somebody $50,000 or maybe $10,000 or something like that, you want to make sure that you're really good friends with them because you understand what they're going to do. If you just give people some arbitrary person and you haven't vetted them all that much, vetted means just trying to understand who they are and becoming friends with them and, developing a relationship, then you are really exposing yourself to fraud. But, if you're investing and you're giving somebody $10,000, you have to be very cognizant of them and be friends with them, and that exposes you to agency problems, right? So the other person can just walk away and not do anything, and what are you going to do, right? Like if you have this friendship, you're going to ruin your friendship, but at the same time, you're going to be a little bit jaded because of it, right? So that is an important thing to worry about and to think about, and why it's just easier just to go to some third party and give them your money, and it's going to mitigate all of these sort of agency and sort of social problems that happens, right? Or personal problems that's going to happen. And you have to be really cognizant of that when you're doing it. So if you like this video, and in this video I did talk about the 4 or 5 different reasons why it's better just to invest in index funds or mutual funds compared to startup investing or investing in any sort of high risk venture like Bitcoin, for example. You can look at all these different reasons, right? The one that I think about the most is that all these ideas and all these sort of high-risk ventures are going to be incorporated into the stock market anyways, into these large companies. That's why they have growth of 10% every single year for years and years and years, for probably 100 years at this moment, that they have growth of 10%. It's because that they're incorporating all these great ideas, and all the other ones that are not growing that much, right? They don't make it into the stock market. You're not going to be investing in those. So that's it. If you like this video, give me a thumbs up, as well as check out my other videos. I do try to put out as much helpful stuff as I possibly can. This is part of my Startup and Small Business Strategy Saturday stuff, where I talk about all these different factors of what you should think about with creating a startup or having a small business, and why it's so important to think about these kind of things. So that's it. Have a good day, and I'm looking forward to seeing you on the next video. Bye.